I'm Jill Casper with Mid-Minnesota Federal Credit Union and a speaker for the Bridges Speakers Bureau. Today I'm going to give you a brief presentation on what is a credit score. For many of you students right now, you're focused on your GPA, which at this point in your life is very important. Once you're out of school, there's another 3-digit number that's going to carry you probably for the rest of your life, and that is your credit score. A credit score is a measurement of risk. It lets your lender know, whoever you're borrowing money from, are you going to pay back this loan? How risky are you? Credit scores run anywhere between 300 and 850. 300 being the lowest and 850 being the highest. I will tell you, those who have an 850 credit score know it because it is extremely difficult to get. Your goal is to be above a 720. Because what a 720 does is it lets your lender know, you know what? This person isn't very risky, we can get them the loan, and you're not going to pay as much money for that loan. So as a financial institution, we make money off of loans. So the higher your credit score, the lower your interest rate, the lower the cost of that loan. The lower your credit score, the higher you're going to pay for that because you're risky, right? It's a measurement of risk. You really don't want to be below a 600 because you will pay higher interest rates and more than likely will not get approved for the loan. Who uses a credit score? First person is going to be your bank, your credit union, your student loan vendors. They use it to determine, number one, am I going to give this person a loan and how much it's going to cost them? Your auto insurance companies also use this to determine your insurance rates. They have determined that the lower your credit score, the riskier driver that you are. They've done a lot of science around that. So the lower your credit score, you're going to pay a higher rate in car insurance. And finally, employers use it. Employers use it to say if you've got a higher credit score, you're more than likely to show up to work on time. You're more than likely to be a responsible, trustworthy employee. Now, on a side note, in 6 states, that is illegal now, but Minnesota is not one of those states. So I would hate for you to go through 4 years of college, work really, really hard for your dream job and not get your dream job because you have a poor credit score, right? So you as students right now, more than likely, don't have a credit score. So you're not a 0 and you're not an 850. You're just no credit score. And that's not necessarily a bad thing. So if you were to apply for a loan right now, we're not going to start you out as an A student. We're not going to start you out as an F student. We're going to start you out as a C student as we look at interest rates. So that's fair. And everything that you do from that point forward either gets you up to that A student or drops you down. And just like your GPA right now, it is really hard to bring it up and maintain it, and it is very easy to drop it. So 35% of your credit score is, do you pay your bills and do you pay your bills on time? That is the biggest piece of that. Do not be late on your bills. All right, if my bill is due on the 1st, if I'm mailing it in, I mail it out 5 days beforehand. But most of my bills I have automatically come out of my checking account and pay because I never want to be late. Now, when I'm saying the bills, these are bills that report to a credit bureau. So those are going to be your student loans, they're going to be your car loans, your credit cards, anything like that. I can pay my rent on time every month, but that's not going to increase my credit score. I can pay my cable bill on time every month, and that's not going to increase my credit score. So these are things that report to the credit bureau. In my longer presentation, we will talk about that. How much money do you owe is 30%. Now, if I'm a millionaire, I'm going to owe more money than a college student. So what we mean by what I owe is if I have 5 credit cards and they're all maxed out, I've used all the money I can on them, and I do that every single month, I owe a lot of money of what I'm capable of paying, right? That's a big red flag for us because you're utilizing all this credit and not paying cash. That means you don't manage your money very well. So that's a red flag for us. Then we go down to length of credit history is 15%. How long have you had credit? You really need to be 18 to get credit on your own. So here's what my family did. My oldest daughter was very responsible. I want to put that out there first. When she turned 18, we did 3 things to build her credit. Number 1, we got her a $500 Visa card. She only uses it for gas and pays it off every single month because that's how she controls that. She pays it off every month. Now, I've got other kids, I will not allow to have a credit card because I don't believe that they're trustworthy enough to be able to do that. The second thing we did, we got her an overdraft line of credit on her checking account. So if she were ever to bounce a check, right, she can use that. She never does, but it sits out there and that reports as good credit for her. Now, if you're not comfortable getting a credit card, if you do not want to do the line of credit, you can do what's called a savings secured loan. So this is a loan that, let's say I've got $500 in my savings account. I apply for a $500 loan. The financial institution freezes that $500 and gives me a $500 loan, and I use that money to pay that off. So if for some reason I don't make those payments, the credit union, the bank, has the money right there. So it's guaranteed. You will not need a cosigner. The interest rate on that is extremely low. So she did one of those, and then when she paid that one off, she did another one. So she had credit starting at 18. And her credit score, I believe right now, is a 760, which is very good for a 23-year-old. Okay? So those are 3 things that you can do. Discuss this with your parents, discuss it with your financial institution, what works best for you. Okay? 10% is new credit. How much new credit have you taken out? It's going to show on your credit report, which is kind of like your report card of what you're doing. If you go and apply for 5 credit cards and a bunch of loans, it's going to show on there. And we as a financial institution are going to say, wait a minute, why does this person need all of this credit? What's going on with them? The other important thing you need to realize is that every time you apply for a loan and they do a credit pull on that, we call that a hard pull, right? It's going to lower your credit score a little bit. So every time you apply for that Kohl's card, when you walk into Kohl's and get denied for it, you're knocking your credit score down a little bit. Now, I'm applying for a car loan this week. I'm going to apply it where I work at the credit union. It's going to knock me down a little bit, but because I'm responsible, it's going to come up very quickly. But especially as a young person, you can't take all those hits because you don't have that credit score established yet. Okay? And finally, 10% is what kind of credit do you use? There's 2 different kinds of credit. There's revolving credit, which are your credit cards, and lines of credit. Okay? Then the second one is your installment credit. Those are those things that you pay $100 a month on the first of the month for 2 years, right? So your car loans, your house loans, your snowmobile loan, your student loan. You really do want a combination of those 2. Now, if you are not responsible enough to have a credit card, please, please, please do not get one. It is one of the fastest ways to raise your credit score, but it is also one of the fastest ways to drop that credit score. So all of these things together, and it's a rough science, but all these things and all these decisions that you make from this pie chart here are what's going to either increase that credit score for you or decrease it. Okay? Many of your parents don't even know this. It's a great slide for you. So what's not considered? Your race, color, religion, are you male or female? Are you married or not? None of that matters, right? It's just, do you pay your bills? Do you pay your bills on time, and how do you handle your money? Your age doesn't matter. My mom's best friend retired at age 65. Paid cash for everything her entire life, probably the most financially responsible person I've ever met. She went in to get her first new car for her retirement. She had the same credit score as many of you that are watching this. She had no beacon, she had no credit score. Very responsible 65-year-old because she had never played this game that we're talking about here. Your occupation, employer information, and how much money you make does not matter. It does. If you make $1 million, doesn't matter for your credit score. It's how do you manage your money. Where you live, current interest rates being charged, none of that matters. Because what a credit score does is it gives the lender really a non-biased way of lending. Because if student A comes in and say, oh, I know your parents, I'll give you the loan. Student B comes in, like, well, I don't really know you, I'm not giving you the loan. That's discrimination. So what this credit score does is it gives us a non-biased way of looking at you. How do you build a credit score? Get some credit. Start establishing some credit. For most of you, your first loans you're going to apply for are going to be your student loans. Those aren't going to really start working for or against you until you start repaying them. And that'll be 6 months after you graduate. Make your payments, pay your bills on time. I cannot stress that enough. So maybe you get that first credit card at your local bank that you're working with right now, your local credit union. Keep that card open, because remember, that length of credit history is really important. My daughter, who got that credit card at the credit union, she's going to move out west. She'll bank probably a lot of different places, but I'm going to encourage her to keep that line of credit open to make sure that she has that longevity of that credit. Don't take out loans, don't take out credit cards if you don't need them. It is a way of really spiraling out. It makes it really hard to manage that. Don't max out your credit cards, which means if I have a $500 limit, I use all 500 of that all the time. Again, that's your capacity to pay. That'll reflect negatively on you. And check your credit report. I'm going to give you some tools at the end here of what to look for on there. Fraud happens a lot. So really keep up on your credit report and taking a look at that. Kind of real quickly, how do we use it? If you're looking at the graph here, you'll see if you're a 720 to 850, you'll see your interest rate on there is 6.7. If you're a 500 to 589, you would automatically not even qualify for the loan, right? Now, if you look at the monthly payment only from the good credit score to the lower credit score is only $50 a month. And people look at that, they're like, oh, that's only $50 a month, it really doesn't matter. But if you go to the other column and look at the interest rate, the person with a good credit score pays half of what the person with a bad credit score pays in interest rate. And that's what you really, really need to look at, because when you're looking at those higher interest rates, the example here is on a $10,000 car loan. Imagine it's your $40,000 in student loans. Imagine it's a $150,000 house. You're looking at hundreds of thousands of dollars in interest just based on your credit score. This credit score piece is really, really important throughout your life. So there are 3 credit reporting agencies: Experian, Equifax, and TransUnion. They all merge, so if I were to pull all 3 of my credit scores right now from those 3, they're all going to be different, up to about 25 points difference. It's just the way they calculate. I can't even tell you the science behind it. So it depends on the lender, which one they use. What I recommend and what the credit union recommends is that you go to annualcreditreport.com. Okay? You can pull all 3 of those credit reports on there. So when you turn 18, I would, on my 18th birthday, I would go on there and I'd pull the Experian one. And then 3 months later, I would go in and pull the Equifax one. And then 3 months after that, I would do the TransUnion one. And I would do that because you get 1 free credit report from each of these places once a year. I can pull them all on my birthday and look at them, and then I won't pull them again until my next birthday. Well, if I've got fraud or something on there, I may miss that. So by pulling them every few months, you're keeping up on that, you're looking at it, you're abreast to anything, and you can stop fraud faster that way. So again, annualcreditreport.com is what we recommend at Mid-Minnesota. It's safe, it's secure, and it gives you some really nice printouts and they're very easy to read. I have an expanded class that we actually walk through some credit reports. So if you're interested in that, just please give me a call and let me know. Thank you. Good luck.
To learn more, visit bridgesconnection.org/speakers.